Terra, Luna, Three Arrows Capital and FTX. We are at a turning point for sure, but this is far from the end. 2022 has been calamitous for crypto. The Terra network came crashing down over the course of just a few days in May. First, the Terra USD stablecoin lost its peg, then the price of the native Luna token plummeted, and the whole thing collapsed like a house of cards. The ordeal wiped something like $60 billion off the crypto market, and sadly, some lost a lot. Not long after, crypto hedge fund Three Arrows Capital followed. As of March, CNBC said it had been managing around $10 billion. By June, its exposure to Luna was enough to bring it down. 3AC filed for bankruptcy protection shortly afterwards on July the 1st, but then Voyager Digital crypto lender Celsius both followed the same month and cited extreme market conditions for those problems. With September came a thaw and predictions of the end of the crypto winter. But then came FTX. Things are looking incredibly difficult for crypto right now. Investors are rightly shaken by the astonishing events of the last 12 months. But it's not over yet. We've already said that in previous episodes, but we keep hearing it everywhere. Here's Alex Manson from Standard Chartered's SC Ventures.
Digital assets are here to stay. There's no question. You cannot uninvent fire. And that's applicable to digital assets, right? It's a technological invention, evolution, which is ultimately good.
So what's needed to get that evolution back on track? Should we blame individuals, or should we see this as a bigger lesson for everyone?
My instinct otherwise is not to finger point anyone. I think of it as the natural evolution of a new activity, a new asset class in this case. I would differentiate between fraud versus more structural lessons of what's happening. Not everybody is a fraudster, and that doesn't mean that the structure and setup of the industry is right.
Comparisons also abound with traditional finance. Is this Web3's .com bubble bursting, or crypto's Lehman moment? Here's Fabian Astic from Moody's Investor Services.
It's not new in finance. It was actually quite commonplace before traditional financial markets became more regulated. And what we've been observing is the usual pattern of loss of confidence, followed by a bank run, followed by a liquidity crunch, ending in either bankruptcy or bailout.
According to the US Federal Reserve, the free banking era that ran from 1837 to 1864 had seen numerous banks fail. Bank notes at the time were often backed by risky bonds, and those were callable on demand. When a bank couldn't keep up with demand for converting those notes, they could easily collapse. Does it sound familiar? It is this sort of lesson from financial history that is now being pointed to as a way for crypto to move forwards.
There's a few concepts that are applicable to TradFi, and frankly go back many years of lessons learned, of booms and busts, and reflecting on lessons learned from history and finance, which will hopefully help us design the infrastructure and setup of the industry in a way that it is sustainable and robust and ultimately trustworthy.
We have, of course, already been through boom and bust cycles in crypto before. The last 5 years ago, Bitcoin soared in December 2017 to what was then an all-time high of almost $20,000. By early February 2018, it had fallen a whopping 65% and was trading closer to 7,000. Does this prove that crypto has staying power then?
Some people are saying at the moment, if there were no use cases for it, it is likely that they would not have survived the first cycles. And so the fact that we're seeing these cycles implies that there's a use for it.
Alex says a good first move towards rebuilding trust in the crypto industry would be to instigate institutional grade separation of roles.
In other words, separating a custodian from a trading venue, from a settlement agent, and which is absolutely normal in the context of the institutional market, and I think that, irrespective of what regulators will do, the market will ultimately force this.
Alessio Quiglini of Custodian Hex Trust agrees. He says that doing this could go a long way towards preventing similarly catastrophic events in the future.
Bankruptcy is kind of a real rare event in traditional finance, right? Because clients' funds are completely segregated from exchanges that only act as an agent, right, in the financial transaction that takes place on the exchange.
However, as is the case with all forms of evolution, things don't always go right first time. But as things continue, there is hope that regulators will be able to build frameworks that can better support this whole ecosystem. The improvements don't come without mistakes, though, and that will happen again.
Business in economics, there's an element of destruction, and it takes a bit of destruction to rebuild on better, more sound basis. As people learn and draw the consequences of what just happened, you build something better and more resilient, and what's coming out of this will be more resilient, and yes, that's a good thing.
Alright, that's it for this episode. Do like and subscribe to the video for more content like it, and let us know your thoughts on what's happening in the comments or on social media.